Hey everyone, and thanks for jumping back into the Equityverse. Today, we're going to talk about the S&P 500. We're going to be looking at its final yearly return. We're also going to be sort of just reflecting on the year and talking about 2024. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So the S&P had its yearly close today, and you can see that it in fact closed at 4769.82. And coincidentally, this is basically the same valuation, more or less, that it closed at the end of 2021. In fact, if we were to look at yearly candles, you can see here that in 2021, the S&P closed at 4766, and this year it closed at 4769. So basically 2 years have gone by and the S&P is essentially at the same price. I know some people were interested in whether it would get above this candle or not. You can see that the open for the S&P in 2022 was 47.78. So we did come just shy of where we opened up in 2022. Of course, the NASDAQ and the Dow Jones both beat those prior opens, right? So if you look at the NASDAQ, if you look at the Dow Jones, you can see it actually beat that. One of the things we've talked about a lot about this year is that in pre-election years, so basically let me just pull up the index here for the S&P 500. We can look at really four different things, right? We can look at election years, post-election years, midterm years, and pre-election years. And as we've talked about before, pre-election years tend to be the best years for the stock market on average. And of course, this time seems like it's going to be no different. The S&P 500 this year went up 24%. The NASDAQ this year went up almost 54%. The last time the NASDAQ went up at least 53.81%, I imagine we have to go pretty far back here, all the way back to 1999, where it went up over 101%. So this is the largest yearly gain by the NASDAQ since 1999. Note that 1998 also had a very green year of 85%. But then once you get before that, you're well below 100% at that point, right? In 97, it was about 20%. 96 was still 42.5%. 95, 42.5%. So some pretty great gains by the NASDAQ back in the late 1990s, and then you can see we had the dot-com crash. So the NASDAQ did have a pretty good year, up about 54%, the largest increase we've seen the NASDAQ have since 1999. But going back to the S&P 500, one of the things we've mentioned before, again, is that pre-election years have historically offered the best returns for the stock market. And if we overlay 2023 onto this chart, you will see that 2023 has far exceeded even the average of all prior pre-election years, which is this red line right here, going all the way back to the late 1920s. So, of course, what comes next are election years, right? So if we just sort of unselect everything else, election years do not tend to be as good as pre-election years. So I think generally speaking, when you have elections, you have uncertainty. Markets don't really like uncertainty, so they don't really do as well in election years as they do in pre-election years. And that's one of the reasons why pre-election years tend to have the best returns. But if you were to look at 2023 compared to, say, 2016, or, I mean, you could look at 2020 as well, though 2020 was a bit of an anomaly because of what happened. But even in 2020, as measured year to date, it did not outperform 2023. It was just that there was a huge drop, and then from that drop, we rallied strong after that. We could also look at 2012 and see that it's below where 2023 was. We could look, of course, at 2008. It was pretty far down. 2004, 2000, and so on and so forth, right? So 2023 has outperformed the last several election years. So one thing to remember is if we were just to pull up election years and pre-election years, so these two, you can see that on average, election years tend to return about, 14% or so by the end of the year, whereas election years, on average, have only returned 7%. So a lot lower return on average by the stock market in election years than in pre-election years. And one of the things we spoke about a few months ago, if you remember, back in, well, really this goes back to the summer. So in the summer, we were sort of discussing the strong likelihood. No, obviously there's no guarantees, right? There were no guarantees, but we were discussing the strong likelihood of this correction right here. And the reason that we discussed this 5 to 10% correction that was forecast was because in prior pre-election years, there does tend to be a correction in Q3 of the pre-election year. And that was why I said, hey, we likely could get a 5 to 10% correction in the third quarter. However, once we get through that pre-election year correction, normally seasonality dictates a move higher into the end of the year. Not always. I mean, you can always find exceptions to the rule. I believe 2015 was an exception to the rule, right? Where there was a little bit of a rally, but then the market did not continue to go up into the end of the year, and it sort of just slowly faded, and we ended up having a bit of a recession scare back then in 2015. But in 2023, you can see that it did take out the summer high, just like on average, we take out the summer high, right? So the average summer high ends up getting taken out by the very end of the fourth quarter, and you can see that something very similar has happened here again, where this summer high was taken out by the end of the fourth quarter. So a lot of that is more or less played out how it normally does. And, we talk about seasonality, and it's one of those things that maybe pans out, I don't know, like 70% of the time. So, calling for this correction back over here in the summer, right, there's always a chance that view would have been wrong. And it doesn't necessarily negate the likelihood of the correction. It just means, hey, this is what normally happens in pre-election years, so be prepared if this correction occurs. And in fact, we did get, it was actually a little bit more than I was thinking. I think I said 5 to 10%. We ended up getting about an 11% correction, so a little bit more than I initially thought. But it is important to note that with that seasonality does tend to come a bounce into Q4 or in sometime in Q4. And what we talked about over here was you basically had three different things, right? You had Yellen issuing shorter duration, which we said back then was bullish for both stocks and bonds, right? So in October, we talked about, it might have been early November, I can't remember, but it was sometime late October, early November, that Yellen issuing, I guess early November, Yellen issuing shorter duration was bullish for both stocks and bonds. And if it's bullish for bonds, right, then that means, of course, that the yield curve or that the long end of the yield curve is dropping, right? Like say like the 10-year treasury, right? So if the 10-year is dropping, then in the short term, that's very bullish for risk assets. And because Yellen issuing shorter duration was bullish for bonds, meaning the long end was dropping, when you take down that long end, when the long end falls, it takes some pressure off those risk assets, and they tend to rally when the long end of the yield curve falls. And so that was sort of one thing. Yellen issuing shorter duration, that led to a positive tailwind for the S&P. The other thing being, of course, that the market was finally really starting to sniff out that the Fed had, in fact, reached the terminal rate. I think for probably about a year and a half, we've talked about 5.5% as the likely terminal rate. And it seems like that is going to stand the test of time. Now, I'm not saying that it can't eventually go higher, but I do think 5.5% is the highest it's going to go, for quite a while. I mean, maybe in the next cycle, the next business cycle, it'll go even higher. But I do think that we're more likely to get rate cuts before we get more rate hikes. I mean, you could always get an example where, the Fed funds rate comes back down, and then sometime later on in a year or two, it then starts to go back up. But for this business cycle, I do think 5.5% is the terminal rate. And so with a lot of times when you reach the terminal rate, there can be an initial sell-off, and then the market tends to rally outside of that after that sell-off, as the market likes to know, hey, this is the terminal rate, there's no more rate hikes. The market likes that certainty once it really sniffs out that the pause is here. And I think it was made abundantly clear in the Fed meeting a couple of months ago that they were not going to raise. And I think Powell was even asked about the SEP, the Summary of Economic Projections, that previously had said there was going to be another rate hike this year to get us to 5 3/4, but he really kind of pushed back on that, not at the last meeting, but at the meeting before that, sort of implying that they had reached the terminal rate. And so once that happened, that was also a tailwind for risk assets. So you have not only Yellen issuing shorter duration, you also had the market really sniffing out, okay, this is in fact the terminal rate. There will not be another rate hike, not at least in 2023. And then finally, you have seasonality, right? So you basically had the trifecta of things that were short-term bullish for risk assets. And so we've seen the S&P climb as we've gone into the end of the year. And while I did think that it was a tailwind for risk assets, I am surprised that we've printed, what is this? 1, 2, 3, 4, 5, 6, 7, 8, 9 green weeks in a row. I imagine you have to go pretty far back to find something similar, but it has more or less been the path we thought, right? I mean, correction in the summer, going into Q3, and then getting a rally into the end of the year as some of those favorable things occurred. Now, we've talked again about, well, when will there be a correction? And what I've said for the last month or so is from a seasonal standpoint, from a seasonality standpoint, I think around mid-January is sort of the next area of weakness in terms of seasonality, okay? And again, you could look at prior election years and sort of see that, yeah, there can often be a little pop up over the first couple of weeks of January, right? I mean, maybe it drops a little bit, but over the first couple of weeks of January, on average, the market tends to go up. But then there does tend to be some weakness for at least a few months on average. And you can also see that on average, there is a bit of a dip here. Of course, that could be one of the issues, of course, is that 4 of the last 5 recessions have been in election years. So some people say, well, they'll never let a recession happen in an election year. And look, there's no guarantee there's going to be a recession in 2024. Let me be clear. But 4 of the last 5 recessions have, in fact, been in election years. And that's one of the reasons why you have this big dip here, right? If you were to overlay, say, 2020 and 2008, let's see, find 2008 on here, and 2000, right? There have been some dips as in the first half of the year and also in the second half of the year, right? So that's one of the reasons why election years aren't as good, is because at least 4 of the last 5 recessions have actually occurred in election years. If you think about it, the last 5 recessions, 2020, you might just write that one off, but you have 2020, you have 2008, which maybe technically started at the end of 2007, but 2008, 2000, 1980, and I guess there was one in 1990, but that was not an election year. So I would say that, sort of keeping in line with what we've previously said, that the next sort of area of weakness in terms of seasonality likely comes in around mid-January. And that doesn't mean that you can't have a few red days between now and then. It's just that would be where I imagine the next area of weakness would come into, just looking at historical seasonality. That doesn't mean that it has to play out like that. I just want to be clear. We talk about seasonality a lot, and sometimes it plays out like it did over here, and then other times it doesn't, right? So there's always a chance we just go right into the new year and the market sells off, or there's a chance that we rally through the entire month of January. It's just that, we can look at sort of historically what has happened, say, all right, well, there's maybe like a 70% chance of something happening, but that doesn't mean that you should bet everything on it. And in fact, while I talk a lot about seasonality and likely outcomes, my investment strategy for the S&P 500 is actually rather quite boring. All I do is I DCA into index funds, low expense ratio index funds, so long as the risk level on the S&P is below a certain risk level, right? So like if we were to go take a look at the S&P 500 risk, which does take a little bit of time to load because it's loading in like over 100 year or about 100 years of data. For me, I just tend to be a buyer of the S&P 500 or a proxy to it as long as it's below the zero point 0.7 risk level. So you can see right now it is slightly above it. So the market is getting a little bit overheated. And you can see that it's happened many times where it goes above zero point 0.7 risk. But historically, I mean, it does tend to cool off sometime thereafter within the next few weeks. Sometimes it can take a few months. You can see over here, it actually did take a while once it got above 0.7 risk. So you do run the risk of not DCAing for several months if you stop it at 0.7. But the idea is that you just sort of pick a risk level and you stick with that no matter what, whether it's 0.7, 0.75, 0.8. For me, I used to DCA the S&P up to 0.75 risk. But as I've sort of gotten older and whatnot, I feel like I don't take on as much risk as I used to, and therefore I only DCA up to the 0.7 risk level now. And when it goes below 0.7, I am a buyer. So that is my general view on the market and how I navigate the market, right? I spend a lot of time talking to you guys about what I think is going to happen, but I want to be clear. That's not, just because I talk about a seasonal correction, that doesn't mean that I'm going and selling my index funds, right? In fact, I didn't, I even said over here I thought we were going to get a correction in the S&P 500 and that it would knock Bitcoin below its own 20-week SMA, which it did. But even though I thought that the S&P would sell off, and it did, I mean, honestly, like I didn't really capitalize on it myself other than just buy when it came down here. Okay, and I said this on ITC Premium, of course, that I was DCing the S&P at that drop just because looking at favorable seasonality going into the end of the year. And now, of course, it sort of brings up the question, well, what about the inverted yield curve and all that stuff? And that is still an issue, and there's a big discussion, of course, as to whether we're going to have a hard landing or a soft landing. And if you were to look at the yield curve, it is concerning. I mean, I think there's a lot of people out there that just ignore it. But there are prior instances where you have inverted yield curves and it led to pretty bad recessions, right? Now, could this time be different? Hey, anything's possible. I'm not going to sit up here and act like it can't be different. I'm not going to pretend like a soft landing can't occur. It could occur. There are instances in history where soft landings have occurred. I think 1967 is one, although we did get a hard landing a couple years later. I think you could argue sometimes in the 1990s we had soft landings. So it's not like they're impossible. And so that is sort of the reason why having a strategy, an investment strategy that does not necessarily depend on the yield curve is a good idea. But I also go back to this so that I can understand what is the risk in the market. And it's because of that I like to have some cash, right? Like I like to take advantage of the risk-free rate. I like to have bonds as a hedge, especially because I now think higher for longer has been priced in. And I was very vocal back over here, back in October, that this was very likely the low on TLT, because I thought this was sort of peak higher for longer being priced in. And I mean, I think that's the case. And I mean, you can see over here, if you were to go look at CME Group, the market is completely expecting rate cuts to begin relatively soon. I mean, I think it's a little out of whack over here. Oh, no, it's been updated. So you can see there's a fairly decent chance there's going to be rate cuts starting by March. Now, again, the Fed does not control the long end of the yield curve. Like, we know that. And the Fed does run the risk of, if they pivot too soon, and let's assume that the Fed funds rate is not above the neutral rate, R star, then inflation could come back and it could surge back, and therefore the bond market could go lower, because now the market's starting to think, oh, well, the Fed's pivoted too quickly, just like they did in the 1970s. We're going to have inflation come back and all that sort of stuff. So the way that I could be wrong about the bond market having already bottomed is if I'm underestimating the growth of the U.S. economy in 2024. You could still have below trend growth and not have a recession, or you could have a recession which squashes inflation for several years, then we don't have to worry about it. I do think there are still several headwinds for CPI. I mean, I think CPI is more likely to go down than up, at least in the next few months, mainly because housing and other goods and services are the main two components that are keeping it elevated, both of which I think are known to be they're both to be lagging. And I do think for that reason that will come down. But it doesn't mean that, it doesn't mean that the bond market couldn't eventually go lower. So I'm still in the camp right now that this is a significant low. It could be taken out if the Fed pivots too soon, but I still think there's a reasonable chance that this is actually the low on the bond market for, for at least the foreseeable future. It doesn't mean that it can't be taken out a year from now, but at least for the foreseeable future, I think it's a reasonable low, as long as the Fed does not pivot too soon. And if the Fed does pivot too soon and we get another wave of inflation, then it would likely, it would obviously in the short term, it could be good for the stock market. But over the next couple of years, it could be very painful because if you think grocery bills are bad now, what do you think happens if we get another round of inflation like we did in the 1970s? So I think that is sort of the thing that the Fed really has to weigh. But there are signs that the labor market is softening up. The number of open jobs per unemployed worker, I think, is down to 1.34. So there's still more jobs available than unemployed workers out there, which is why the unemployment rate still remains relatively low. Initial claims are still relatively low, although continued claims are starting to go higher. I do think there are some things to be at least somewhat concerned about going into 2024. But as we've said before, the two main things that would lead to a big sell-off in the stock market are either the reacceleration of inflation, which has not happened, and I still think inflation's heading down. So I'm not that concerned about that right now, although it could come back in a year from now if the Fed pivots too soon. The other thing, of course, being the labor market, right? If the labor market were to really slow down in 2024, then that could be the reason that you get a larger drawdown on the stock market. But do remember, the stock market loves to climb the wall of worry until it has a sufficient reason not to do so, and oftentimes that sufficient reason is the labor market finally giving up and starting to show real weakness. We're starting to see some signs of labor market weakness, but I still imagine it has a little ways to go before it's overly concerning for the Federal Reserve to want to cut several hundred basis points. Right now, all the rate cuts that are being considered are just sort of 25 basis point rate cuts at each meeting, rather than 200 basis points of rate cuts at a single meeting. You're only going to get 200 basis points or 100 basis points at a single meeting if we get a hard landing or something. So yes, I think it's a good idea to have a general investing strategy no matter what, where you look at something, you say, all right, well, if the risk is this, I do buy. If the risk is high, then I don't. If the risk is low, then I'm a buyer, and not worrying so much about the day-to-day stuff. So just remember, we'll talk about the markets, we'll talk about likely outcomes, but my investment strategy for the stock market is to look at the risk levels and just stick to those. Okay, so that I think is the thing to sort of think about going into the next year is, when do we get rate cuts? Do they come quickly enough to sort of keep a hard landing at bay, or are they delayed enough where we actually do get a hard landing and we go into a recession? So those are the risks. We'll talk about those risks, of course, in 2024, but just make sure you guys have a plan, stick to it. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. We'll see you guys next time. Bye.